Hello and welcome to the FinTech Finance Virtual Arena. Today we're going to be talking about the Central Securities Depositories regulation. And joining me today I have Pete Tomlinson from the AFME and Frédéric Viard from Bottomline Technologies. Guys, thank you so much for joining me. Pete, how are you doing today?
Very good, thank you, Doug. Thanks so much for having us on. Weather's not great outside, but very, very happy to be here.
It has been a terrible spring. But Pete, for our viewers who might not be aware, could you give them a bit of background to the AFME, please?
Yeah, so AFME or AFME stands for the Association for Financial Markets in Europe. So we are a member-driven organisation. We represent European and global banks, brokers, custodians, and other market participants. And we work on behalf of our members to advocate for stable, competitive and sustainable capital markets. So I work in our post-trade division, so I'm kind of responsible for our work on CSDR. In practical terms, that means helping to coordinate across our membership and the wider industry to ensure there's a common and harmonised approach to trying to implement the regulation, making sure we're all reading the requirements in the same way, and also acting on behalf of our members in terms of engagement with regulatory authorities.
Incredible. Well, thank you so much for joining me. And also Fred Viard from Bottomline Technologies. Fred, how are you doing?
I'm good, thank you very much. So the weather is not so good here neither because I'm based in Switzerland. So as such, we are looking at the European regulation with a specific focus because it's one of our, let's say, main capital market from Switzerland. I'm working at Bottomline Technology. I'm driving our proposition. Bottomline is a technology company, and I'm driving the proposition that we are offering to our customers in the security space, helping these banks customers to meet the regulatory requirements. More personally, I'm working in what we call the financial messaging, meaning how to help our customers to connect to the market infrastructures, trading venue and so on. And I'm really keen to have this discussion with this group today. Thank you very much.
Thank you very much, Fred. Well, brilliant. I guess really then, Fred, if I could stay with you to kind of kick things off. For our viewers who also might not be aware, can you give us a bit of a background as to why CSDR has been introduced?
Yeah, sure. So as you stated at the beginning, so CSDR stands for Central Securities Depository Regulation. It's part of a global initiative in Europe to harmonize the fragmented market. So it goes along with the former regulations such as MiFID and EMIR, and it's a complement of that for the let's say the security depository area of this space. And then this is built around several, I would say, phases, and some of them have already been live. And the one which is really important that will become live in February next year is the settlement discipline regime, which is the SDR. And this is the real challenge for the banks today. It's about how to implement this part of the regulation because it has an impact on all the CSD, but also all the banks who are taking part to the securities chains, I would say, because they will be impacted by the regulation that introduce some penalties and buy-in, and all of that will cascade across the security chain until it reached the root cause of who has the responsibility of having made the trade failing. So it's a really big part of the regulation, which is this SDR part of the regulation that will come live in February 22.
Brilliant. And Pete, Fred gave a brilliant overview as to kind of the impetus behind it, but can I ask really what its aims will be? Because I think that's the best way to tackle what the regulation will be going to be doing, and we'll see from there how we're actually going to go about that.
Yeah, I think sort of Fred summed it up very well. If you think of the different types of kind of core market infrastructure, you've got trading venues who are now regulated under the MiFID framework. You've got CCPs regulated under EMIR. So the aim, in a nutshell, of CSDR is to provide that regulatory framework for the other core FMI, which is the CSDs. So it's trying to create that single harmonized framework with the ultimate goal of improving the safety and efficiency of settlement of securities. as Fred says, when we talk specifically about settlement discipline regime, which is coming in next year, the aim of that is to improve the rate of settlement efficiency in Europe's capital markets. So, it obviously varies by asset class and by, specific market, but it's generally in the high 90s already, but there's a regulatory desire to see that improved even further. You kind of think back to the global financial crisis as the sort of driver of all of this ongoing kind of regulatory initiatives. For security settlement, it's really about trying to decrease the number of outstanding settlement obligations between counterparties, and therefore kind of reducing risk in the market as a whole.
Yeah, I completely agree with that, and I think it's also part of the achieving the target 2 securities T2S landscape, which is really about having a market which is much less fragmented, and that should drive to ultimately a European place where there is no failed trade. So it's really the ultimate goal, and for inciting that, they introduce some penalties on buying, which are quite stringent, but that should help to have a much more fluent place in terms of settlement. So it's really a global initiative at the European level to try to have something which is much more fluent in terms of how we trade and how we settle shares, to have the minimum numbers of failed trades in the European marketplace.
Yeah, so Fred, with that in mind then, obviously you've mentioned T2 with the European Central Bank. It seems like there's a lot going on for a lot of banks that are going to have to deal with all these changes, and obviously for brokers. So exactly what are the new requirements that all these organizations are going to have to really interact with going forward?
So I think that there are CSDR is composed in several elements, and then we can list them. So it's about internalizing the settlement reporting, segregation and disclosure, the settlement disciplines, which is really the key point for our customers today. It's about how to implement the requirements in order to be sure to not be the bad guy in the chain, so to control, to monitor what is in terms of settlement. For the CSDs, for the Central Securities Depository themselves, they have additional requirements in terms of reconciliation. They have to renew their authorization, and they have to really publish a prudential code of conduct of how they will handle that. But again, I think it's really the discipline regime, the settlement discipline, which will impact all the marketplace, and not only in Europe, because it's not country specific. It's really as soon as you have a trade which is settled in Europe, then you fall in scope wherever you are. So it's really about managing the trade allocation confirmation. You have to be sure that it is same day. It is about preventing the settlement fails. So it's really the key part of that. Monitoring and reporting, and then it will be about ensuring that you can monitor and control the cash penalties and possibly to avoid them, and to limit as a maximum the buying regime. So it's really something which is quite stringent in terms of how it will impact the global marketplace.
Yeah, and I think that's really interesting. Kind of reminds me of MiFID II having an impact on a lot of American brokers as well. So, Pete, could I also kind of, Fred, as we mentioned, has touched on the kind of global nature of this. Who is exactly going to be subject to this regulation? What are the kind of knock-on organizations that might not be aware that they're currently going to be subject to it?
Yeah, I mean, Fred's completely right. This will have a global impact, and it's important to kind of realize that is the deliberate intention of the regulators. So the penalties and the mandatory buy-ins will apply to any settlement in an EU CSD. So any non-EU counterparty who wants to kind of trade and settle in European securities will absolutely be impacted by this. The way the regulation achieves this kind of extraterritorial reach is by requiring that these rules are contractually incorporated. So when you think of, even if you think of a kind of simple securities settlement transaction, it can get pretty complicated pretty fast when you try and map that out. You've got the sort of vertical chain from the CSD to their settlement agents to global custodians all the way through to end clients, and you've got this kind of horizontal chain between sort of maybe a trading venue to the broker dealers all the way through to their end clients. So when you kind of map out that matrix, each link in that chain, there is a contractual relationship between those parties, and CSDR mandates that contract is updated to incorporate these rules. So literally everyone who has an interest in European securities will have to comply with the new regulatory requirements.
Yeah, because if we compare, for instance, with SRDII, which is a regulation that came into force last September, it was about the citizenship of the share. So EU company, listed EU company. So this was the criteria. Here, the criteria is where the trade is settled. So whatever the type of shares, as soon as it is traded or settled in the European area, then you fall in scope. So it's much broader than SRDII in terms of number of shares in scope and the global reach that will end at the end of the journey.
See, now that's really interesting. And Pete, you brought up how one of the aims of the regulation is to bring up that number even into, it was already in the 90s, but bring it into the high 90s. So, Pete, what will be the buy-in risks for instance, Asian asset management firms that probably weren't used to that kind of European level of settlement failure going forward?
Mm-hmm. Where CSDR is kind of different, and particularly when we're talking about the buy-in rules, buy-ins do exist they exist today in Europe on CCP cleared transactions. The CCPs have their own buy-in rules. They need to do that to manage their own counterparty risk. In certain Asian markets, you have buy-in rules for transactions executed on a trading venue. The important thing to note here is that there is no kind of central operator of the buy-in. So for non-cleared transactions, the responsibility for actually executing the buy-in falls with the trading counterparties. So really, I would say that the key thing for your hypothetical Asian asset management firm is to know that they have a regulatory responsibility, and if they are the receiving party, so someone fails to deliver securities into them, they have the responsibility to actually execute that buy-in. So that means appointing an independent buy-in agent who will potentially require them to kind of post collateral in order to execute the buy-in on their behalf. It's a huge kind of operational headache to get your head around. And as I say, one thing which I think is to be honest, the flaw in the regime is it places this requirement on the injured party, so to speak. So they've done nothing wrong. Someone's failed to deliver to them, and now they suddenly have a regulatory obligation. So you could be a long-only fund who never fails and only rarely transacts in Europe, but you still have to be aware of this and prepare.
Yeah, well, that's really interesting. And Fred, could I also get your perspective as well? Because I think Bottomline, you guys operate in various different geographies.
Yeah, so sure. So we have customers in Asia as well via our branch in Singapore. And agree. So in Asia, traditionally, there is a strict culture of settlement. So the ratio of fair trade is very low, and the players who are ensuring the buying might be different in Asia. So it will change since they will have something settled in Europe. So the Asian firms, they have to be prepared that they will be part of the game. So they have to be ready to manage the new information coming in the SWIFT messages, for instance, the penalty that will be into the messages. So they will have to adapt their environments in order to be able to support the new requirements through the reporting ask, and also for the messages that will transport the information. So they have to really assess their exposure to the European market in terms of what they are doing in Europe, to be prepared to be part of this bigger game in terms of buying and discipline and this new regime that will impact them.
Interesting. Now,
just to re-emphasize that point. So in, for example, Hong Kong, if the buy-in is executed by the trading venue itself, as that sort of end buyer just waiting for your securities, you don't need to do anything. Whereas now you actually have a proactive role in the process. So that's this is something that's kind of brand new, really. It's not replicated in any jurisdiction.
Yeah, I agree. So in Asia, you have some places where the stock exchange and the CSD themselves will act as a CCP somewhere, and here it will change. So they will have to really monitor these exposures in front of the European market.
Well, Pete, you brought up as well, it's almost like the injured party has to manage that burden. So, I mean, is this going to continue? Is that going to just be prolonged in the fact that you will always have to manage that compliance risk? Is that going to just fall on the broker going forward?
As I said, the contractual incorporation requirements sort of mean that everyone does have that compliance risk. But will we kind of see outsourcing of the actual operational function of the buy-in? Quite possibly. I think sort of being pragmatic, do all buy-side clients have the capability and the capacity to actually manage that buy-in process from start to finish? In a lot of cases, maybe not. So they might look to their brokers or service providers to actually, to take control of that process of appointing a buy-in agent, settling the buy-in, and any sort of price differentials arising from that. So the sort of ultimate end buyer can take a bit more of a passive role, but they would still, I would emphasize, as per the regulation, they would still have the regulatory responsibility, but might outsource the operational side of it to a different party.
Yeah, I agree. I think that the responsibility will cascade throughout the security value chain. So of course the broker will be probably more exposed, because these are the guys who might be in a position to be short sellers, and then they will have to control these positions. So I would say CSD and brokers will be probably custodians, and brokers will be probably at the front line of that. But again, this is something that will cascade throughout all the chain. So I think the responsibility is split and shared across all the players who are taking part to a trade.
Okay, well, we've discussed really where the kind of risk will fall, and really we've talked about the regulation and what it's going to be imposing, but I think it's probably interesting to raise awareness on what the penalties will actually be, Fred. If you could tell us a bit more about that. Sure.
So the penalty regime is quite well defined, and it will depend on the asset type. So it will vary from 0.1 basis point to 1 basis point, and it will let's say this amount will vary about if it's a liquid share, a liquid, a corporate bond, a governance bonds, and all of that. So the penalty will be really well established, and they will we have to keep in mind that they will increase over time. So the aging of the delay will have an impact on the cost, and after that you will have the buy-in regime that will apply. So there is really a stringent set of rules with cost and penalty that you can have. So it will be very important for the players across the chains to first avoid to be under penalty. So and I think in this space it's important that the information which is transported over the network, such as SWIFT, will help to do that, because you have inside a message. So if you look at the information which is transported, you have some information that can be used to monitor and to anticipate potential penalties and failed trades, because you have the trade date, you have the settlement date, so you can monitor the aging of that. That will be really important, because the penalties will increase over time as long as you are not able to deliver the shares. Okay, and Pete, can I also get your perspective on that? Do you agree that they are outlined in crystal clear fashion?
Yeah, absolutely. I think the penalties are one of the less challenging aspects. The buy-in rules are certainly more confusing and sort of harder to implement. The penalties, again, these are managed by the CSD, so it has a sort of central points of control, and the CSDs will charge the penalties to their direct participants, and it can flow through the chain that way via kind of standard messaging, as Fred's mentioned. The penalty rates, as they're currently calibrated, could offer a sufficient incentive to make sure settlement happens on time. When you think of 1 basis point per day for a liquid share, that's more expensive than it probably costs to borrow that share in to cover your failing delivery. It's possibly going to wipe out any kind of trading profit if you're a sort of liquidity provider or market maker. So failing for 1 day, it might be enough to really encourage you to make that delivery. And as Fred says, that's a daily rate, so that it certainly adds up as fails kind of persist over multiple days. The other kind of important thing to mention is that CSD doesn't retain the penalty. So if they charge a penalty to me for failing to deliver to Fred, they will also credit that penalty to Fred. So it's a sort of a zero-sum game. There's going to be winners and losers based on who can settle their transactions most efficiently. So yeah, I think it's definitely a sort of positive step forward for encouraging greater settlement efficiency.
Yeah, wow. And you've both kind of brought up the changing nature in terms of the infrastructure, but behind it, Fred, you actually brought up Target 2. But speaking of the new international standard, Fred, ISO 20022, what's that going to mean for CSDs going forward?
So ISO 20022, it's a long story, because this is really a new language which has to be used and understood by the marketplace. Whatever it's in payments, we have seen the Swift CBPR Plus for cross-border payments that will move over 20022. A lot of domestic network and clearing systems are already based in ISO 20022. In Switzerland, for instance, we are already running ISO 20022. And then, so there is a big focus on the payment side, but the security side has a slightly different standard already, which is 15022, which is a standard which is a bit more suitable for the securities market. But of course, there is the equivalent in ISO 20022 for almost all the business aspect of the exchanges. So you have the settlement messages in their current format plus the equivalent in ISO 20022, but there is no real regulatory driver to force the banks to use ISO 20022 for settlements. It will be probably more market driven in that space, with custodian providing more information via ISO 20022. For CSDR, I think the existing Swift fin messages, the 537, for instance, they will incorporate new fields for penalties, and there will be a new message in ISO 20022, SEEMT 44, I believe, which will also can be used for the penalties. But we don't know really what will be the usage of this 20022 new message compared to SRDII, because SRDII, which is another regulation, it was based from inceptions on ISO 20022 for the disclosure and for some of the General Assembly parts. So it was really a big impact on the banks, because they have to not only manage the format but also manage the rails which are transporting these messages. So it was quite a challenging aspect of the SRDII regulation, which was with ISO 20022. We don't really know at this stage what will be the impact on ISO 20022 on CSDR. But again, I think it will be around the settlement messages, the incorporation of penalties, but there is no real regulatory driver to use these ISO 20022 messages, as far as I know.
Okay, and Pete, do you agree it might just be a kind of industry-wide adoption, just purely out of the benefits that you could see out of the new international standard?
Yeah, I would agree. From a CSDR perspective, my understanding is that for all the new notification requirements, things like the penalties reporting, buy-in notifications, 15022 and 20022 are both being developed. So we're going to be in this period for a few years where kind of both standards are existing in parallel, and there's going to be a sort of gradual move by the market across to 20022. It's something for everyone to manage over the coming few years, that sort of transition and supporting clients and counterparties who are maybe not as quick to adopt.
Yeah, there will be a coexistence period in many areas, and this is actually the challenge, because you might receive the same information but from different rails, and you have to combine the two and understand which rail will be used for such business aspect and what are the other routes for the rest of the business. So there is a big challenge around ISO 20022 in both the payment and security space. But again, there is no real mandatory need for using ISO 20022 compared to SRDII, which was based from scratch on ISO 20022, and it was a big impact. So I remember discussing with our customers to understand that they will need another rail to exchange these messages. What was new for them. So they say, okay, I need to not only understand a new XML message in ISO 20022, but I need to set up a new rail for being able to send and receive these messages. So it brought a lot of confusion on the market, And that's the reason why companies such as Bottomline were offering some translation tool and coexistence possibility across the various networks. So this is something which is really required, because the backend system, so the back office system that the banks are using, most of them are not really ready with XML 20022. So they need to manipulate this format, to transform, and also to ensure the coexistence of the two. So it's ISO 20022 in itself, it's a big challenge, but the aim of it is really to have something which is completely machine readable. So if you look at the current standard, you can have some fields that you can enter manually, so you can have some free text. These will be prevented with ISO 20022. And this is the only way to have something that will be 100% end-to-end straight-through processing.
Interesting. Now, Pete, Fred brought up SRDII as well, which obviously got implemented in September. What is your holistic view on how these two regulations are going to have on the securities industry going forward?
I think it's hard at the minute for me to look beyond the immediate compliance challenges. So SRDII, Fred's touched on one of the reasons why that has been difficult for the market to implement, a lack of readiness in certain parts of the market. Also, the differences in national laws, meaning that there were slightly different transpositions of directive on a member state level. I don't think you'll find anyone who thinks that SRDII has been entirely successful so far. CSDR has its own challenges as well. So the Commission has been getting market feedback on settlement discipline and other topics as part of the ongoing CSDR review. So even though the rules haven't gone in yet, 3/4 of the people who responded to the Commission think that the rules need to be changed already. So that includes AFME. In particular, the mandatory buy-in is not seen as something that's the most effective way of delivering the objectives of the regulation. So we'll have to wait and see what happens with that. But the industry is expecting, I think, challenges with implementing CSDR as well. I don't want to be entirely negative, so I'll definitely say that the objective and the spirit of both SRDII and CSDR is good and are widely supported by the industry and by AFME members. They're both steps in the right direction towards harmonization in Europe and better and more efficient capital markets, but there's definitely some barriers to overcome still.
Yeah, I completely agree. I think the intention is very good for both. So SRDII is about providing more, let's say, control on the shareholders, more visibility on what it's doing, and both of them are about protecting the customers at the end of the day. But they will introduce some big challenges, and I think it's important. You notice the point, Pete, about SRDII, which is a directive which has to be implemented country by country, compared to CSDR, which is a regulation, which is one fit for all. So the level of interpretation around SRDII was higher than the CSDR, which let less room for interpretation. But again, so I think these initiatives are going in the right direction, making more harmonizations, trying to protect the customers. But they are bringing a lot of challenges as well with them. So I think it will be a big challenge for all the marketplace to comply with this regulation moving ahead. So I mentioned the challenge around SRDII, and one of them was about the topic which is about disclosure. So you have to disclose the customers who are in scope, and you have also to help them voting. So it's a big challenge, and all of that being based on ISO 20022 messages. So for instance, we have in Switzerland a lot of customers who needed our help, and we provided them with tools for helping them to apply the thresholds, and also to help to disclose them in the appropriate format and to manage the voting. And we did that for about 50 customers in Switzerland, because they were a bit in front of a big challenge to manage the format, but also to manage the workflow, which is about you receive a request for disclosure, who is in scope, so you have to interact with your backend systems to build the response to disclosure. And after that, you need to help the shareholders of the banks to vote on some specific topic. So these SRDII introduced really new requirements, which was really challenging for our customers to implement.
Brilliant. Well, guys, I think that's all we have time for. But I know there's a hint of negativity, but ultimately it sounds like the industry is moving in the right direction. So, guys, thank you so much for your time. I hope you've enjoyed yourselves as well. I certainly learned a lot today. So, thank you very much.
Thank you.
Thank you for having me. Cheers.
Thanks very much. And also to all our viewers as well, thank you for watching. You can catch the rest of the series and much more over at www.fintechf.com and of course YouTube and LinkedIn, where I will see you there in the comments. So guys, once again, thank you very much and goodbye.